What is a short squeeze? There's a fairly complicated yet simple explanation behind this, and with all the Wall Street bet AMC apes out there, it's become imperative to know what a short squeeze is. Stay tuned for the rest of the video to understand what this means. Hello guys, welcome back to PrizeDr's YouTube channel. This video is in the hashtag investment for dummies playlist, and today I'm going to talk about what a short squeeze is and how you could use it to make money. A short squeeze is usually when a stock or security goes up in price rapidly. For a short squeeze to occur, the stock must have a lot of short seller holding positions behind it. The short squeeze begins when the price jumps higher unexpectedly, and it starts when a significant measure of short sellers coincidentally decide to cut losses and exit their positions. That's the more confusing version of it, but let me break this down. Short selling is a fairly simple concept. An investor, let's call him A, borrows a stock from investor B and sells the stock to investor C, then buys the stock back from investor D to give it back to investor B, and he returns it at a later date when the price is hopefully lower. Short sellers are essentially betting that the stock they sell will drop in price in the future, and the difference between the sell price now and the buy price in the future is what's called their profit, and it can be extremely lucrative. In the real world, it works something like this. You want to short a stock, so you put a request with your broker to do so for, let's say, 100 shares worth. Your broker, for a fee of course, lends you the stock and you instantly sell those 100 shares at current market price. Now, you need to give back those shares to the broker before the expiration date on your agreement, so you decide to buy it back at a future date at a lower cost and give the shares back to your broker, therefore settling your agreement, and the difference between the price you sold it at and the price you bought it at is what you make in profit. So short squeezes happen when the short flow is high. The short flow is the name for all the shares available for public purchase. The higher the short flow, the more shares have been borrowed by short sellers, and then they need to buy them back. Essentially then, when the short flow is high and retail traders only buy and don't sell, short sellers need to buy back their shares, which creates buying pressure, pushing the price up. The funny thing about this is that when short sellers exit, they also manage to push prices higher. This continued rapid rise in price also attracts buyers to the security, which in this case would be a share or a stock. The combination of new buyers and panicked short sellers creates a rapid rise in price that can be stunning and unprecedented and can last a while, pushing prices astronomically high. Let's take a look at what happened to GameStop earlier this year. Approximately 140% of GameStop's public flow had been sold short, and the rush to buy shares to cover these positions as the price rose caused it to rise even further. The short squeeze was initially and primarily triggered by users of the subreddit r/Wall Street Bets, an internet forum on the social news website Reddit, although a number of hedge funds also participated in it. At its height, on January 28, the short squeeze caused the retailer stock price to reach a pre-market value of over $500 per share, nearly 30 times the $17.25 valuation at the beginning of the month. The price of many other heavily shorted securities and cryptocurrencies also increased during this time, one being AMC. Now currently, the most notable short squeeze that's happening is with AMC. AMC Entertainment, for those of you who are not in America, is a massive movie chain that was at, well, the short end of the pandemic as cinemas shut down. Massive short interest happened mainly from hedge funds, which caused the price to crash below what the intrinsic value that most investors believed AMC was worth. Now some sources say that the short flow was reported to be as high as 250%, depending on your source, which is crazy when the average stock has around 1 to 2% short flow. This then caused the so-called apes to band together, and the short squeeze we're now seeing is a result of that. So now you know what a short squeeze is, and you know an example of what a short squeeze is. But you might be asking, should I invest into one? To that I'd say only invest any money you don't mind losing into AMC, as it's a highly volatile stock that has massive swings in prices every day, let alone every week. But the main thing is to buy and hold, as that means you're joining the movement of stopping hedge funds dictating the market. Remember, this is not financial advice, this is financial edutainment only, so only follow this after you feel comfortable doing so. That's it for this video, hope you enjoyed. Let us know what you want to see on Investing for Dummies next. Be sure to give our site a visit where you can earn some free, easy gift cards in exchange for a bit of your time. Thanks for watching, and until next time, it's been PrizeDr, signing out.